Hello class, this is your instructor James Bosnick, and we are going to start off with Chapter 2, the Expanded Tax Formula, Form 1040, and Basic Concepts. Learning Objective 1 is going to be the expanded tax formula and the major sections of the Form 1040. So the tax return itself is going to have a basic Form 1040, which is just going to be the 2 pages of the form itself, and will be completed with various schedules that are going to be attached to that based on the taxpayer's individual situation. The adjusted gross income is going to be the gross income minus a list of permitted deductions, and we will see that in the expanded formula on an upcoming slide. And then we're going to have many deductions and credits that are going to be based on that AGI that will be subtracted from the adjusted gross income to get us to tax liability. So here is the expanded formula. We're going to begin with gross income, which is going to be section 61 of the Internal Revenue Code. We're going to subtract permitted deductions as a from AGI, or excuse me, as a for AGI deduction. So that's going to be from gross income to arrive at the adjusted gross income. And then we're going to subtract from AGI deductions, and that's going to either be a standard deduction or various itemized deduction if the tax filer is itemizing to arrive at taxable income. Once we have taxable income, we'll multiply by the appropriate rate based on the schedules that we will see later in this course to get tax liability. Once we arrive at tax liability, and that's going to be the amount that the tax filer owes for the course of the year, but may not be the amount that they write the check out for, and that's because there's tax credits that might be applicable to reduce that liability or other taxes that might be added. And most tax filers pay a portion of that tax liability throughout the year through either a payroll tax, through withholding it from their payroll rather to pay the payments to the Internal Revenue Service for that tax liability over the course of the year. So when it comes time on April 15th, to meet that obligation, a portion of that tax liability has already been satisfied with those withholdings from the payroll or from various other means such as payment of estimated taxes along the year. But if an amount is still due on that tax filing date, then payment will be due as well in that amount. If more was collected than the tax liability over the course of the year, then tax filer will be entitled to a tax refund. Come to our first concept checks here. When preparing a tax return, you will seldom use any of the schedules. True or false? That is false. The 1040 itself is just initially going to be 2 pages, but we're going to be attaching various schedules based on the tax filer's situation. 2. The concept of adjusted gross income is important because many deductions and credits are reported on the tax return are computed based on the amount of AGI, and that is going to be true. Learning objective 2, determine the proper filing status. So when completing the Form 1040 and knowing which schedules we're going to look at, a lot of this is going to be based on filing status. And most tax filers or most people are aware of 2 general statuses. You're either not married, so you're going to be filing as single, or you are married, so you're going to be filing as married. But it's actually broken into 5 specific filing statuses. The first is single. So if you're not married on the last day of the year, you can file as single for your filing status. If you are married on the last day of the year, you can do what is called filing as married, filing jointly. So you're going to be grouping all of your information together and filing as a common tax filing. And the marital status of the couple is determined under state law. So it's not a federal overview for that. If the state says you're married, then in the state in which you reside, then you can use this filing status. And it also does not matter if only one of the spouses has earned income. So if you have one spouse that is a stay-at-home spouse and one spouse that is a working spouse, married filing jointly is still going to be an appropriate filing status. Now the other 3 statuses that we have is 1, married filing separately. So you are going to be married, but for specific reasons, you may elect not to file as married filing jointly. So you're going to file each your own tax return and use the Social Security number of the spouse to reflect that on each other's tax return. So you're telling the IRS essentially, we're married, here's the Social Security number of myself as well as my spouse, but we're electing not to file jointly. So the standard deduction would be taken as if they were single, essentially. You're going to be splitting that married filing jointly, the standard deduction. Usually there are unusual circumstances here that's going to make someone intentionally wanting to do this. And one aspect might be being difficult to get access to information from the spouse that's required to be on that reporting. So if you're in the process of going through a divorce or something like that, and the spouses are kind of closing, keeping information from each other, this might be one aspect to where the spouses would file in this situation because they didn't have access to the tax information that needed to be reported and didn't want to share with each other, but still wanted to make their individual filings. So the fourth filing status here is going to be head of household. So this is going to be an unmarried person and can possibly still be someone that had been married but is now living apart. During the last 6 months, they might qualify as unmarried. They need to be a U.S. citizen, and they must maintain a household for a qualifying person for more than half the year. So this might be a dependent child, or this might also be dependent parents. But the idea is it is a tax filer that is also responsible for someone else. So they are going to have a different filing status here, and they're going to get a benefit on that standard deduction that we'll see later in this slide deck. And then the last is going to be qualifying widow with a dependent child. So this filing status is only permitted for 2 years. So once the spouse has died, you had to have still been married, so you have to be eligible to file a joint return the year the spouse dies. And then you can file for 2 years as a qualifying widower with a dependent child. You must be unmarried to retain this filing status. Once you marry, you would no longer be able to use it. And you must pay for more than half the cost of the household member, the household that is a principal place of residence for the taxpayer and the child. And then temporary absences are permitted. So if the child were to go off to college, for example, for 4 months in the term, that absence is not going to count against the tax filer. So our concept checks here. Even though you are in the process of getting divorced, you can file as married filing jointly. That is true. As long as you're married on the last day of the year, you can elect that filing status. 2, the Social Security number of the taxpayer spouse must be shown on the taxpayer's return when filing as married filing separately. And that is also true, and that's because you have to notify the IRS that you are filing separately, and so it will essentially flag for the spouse, which should be doing the same thing. They should be filing as married filing separately as well, and correspondingly using your Social Security number as the cross-reference. 3, a surviving spouse who qualifies as married filing jointly when the spouse died can file as a qualifying widower for the next 2 years, as long as the surviving spouse pays for more than half the cost of keeping up the household and does not remarry. And that is false. So learning objective 3, determining dependents. So taxpayers have related individuals that live with them, and they're going to be provided financial support. What we're going to want to do here is to see whether those individuals that are being provided support qualify as dependents. And there's going to be certain tests that we're going to walk through, similar to the tests we saw for filing status, to see whether the individual would qualify as a dependent. And it's important to know for the qualification dependent, it's going to impact whether or not, for example, a child credit can be reported, or whether or not what your filing status is going to be, and there's other tax matters that will come up where knowing whether the individual is a dependent or not is going to be important. So before we get into the specific tests, there's 3 general tests the dependent needs to meet as well. One is called the dependent taxpayer test, and if a dependent can be claimed as a dependent by someone else, then the taxpayer cannot claim this dependent on their return. So you can only be claimed as a dependent on someone's tax return once. If you're claimed, for example, if a individual is claimed by a parent, then even though they might be staying with a relative, they can't be claimed by that relative as well. Or if they are legitimately claimed by that relative, then the parent should not be claiming them. So you're going to have to look at what the situation is. We'll go through the tests a little later in the slide deck to know whether or not the individual will be a dependent of that tax filer. But the important thing to know for this purpose, for this test, is that only one person can be claiming you as a dependent. The second test here that needs to be met is a joint return test, and that is that the person claimed as a dependent cannot file a joint return with a spouse. So here, unless the return is just to claim the refund as a no liability tax return filing. So here, if a parent has a child that they want to claim as a dependent, the child has subsequently married and has earned income, then the parent is not permitted to take them as a dependent on their return because the child has failed the joint return test. And then the exception to this, as you see, is if the child had a small like grass cutting job over the summer or something like that, and would be entitled to all the taxes that they paid back. So they have no liability and are simply just filing the return to receive the tax withholdings. So then they could still be permitted to be filed, permitted to be included rather on the parent taxpayer's filing. And then the third general test that we have here is that they have to be a citizen or a resident. And that's going to be a U.S. citizen, resident, or national, be a resident of Canada or Mexico, or be an adopted child of the taxpayer if the child is a member of the taxpayer's household all year and the taxpayer is a U.S. citizen or national. And then going into the specific tests, here we have that the qualifying child must meet 5 specific tests. And the first is going to be a relationship test, and that is that the dependent would need to be a child or descendant of a child, and that's going to be a grandchild or a great-grandchild. Need to be a stepchild, an eligible foster child, or a brother, sister, half-brother, half-sister, stepbrother, stepsister, or a descendant of them. So the brother's child, grandchild, great-grandchild, the sister's child, grandchild, great-grandchild, and so on. The second test here is going to be an age test, and here the child must be either under the age of 19 or under the age of 24 and a full-time student. And the full-time student is going to be in school full-time for any part of each of the 5 calendar months during the calendar year. And then if you're totally or permanently disabled, then you will be deemed to meet the age test regardless of age. The third test here is going to be a residency test, and that's going to be that the child needs to live with the taxpayer for more than half of the year. And again, temporary absences are not going to count against that. So if the child goes off to school, to college for 4 months and then comes back, then that 4 months does not count against the residency test, does not count against that time. Support test, the child cannot provide more than half of his or her own support. And then there's a special test for qualifying children of more than one taxpayer, and typically where this would come into play is if a couple is getting divorced and both want to count the child as their dependent. The divorce proceedings, you can elect which of those tax filers would be permitted to count them as a dependent. So concept check 1, what are the 5 specific tests you need to meet to claim someone as a qualifying child? And it's the 5 we just went through in addition to those 3 general tests. To meet the age test, the child who is not disabled must be either under 19 or under 24 and a full-time student. And then 4 years after 2008, the child must also be younger than the person claiming the dependency. Learning objective 3, determining dependence. So here, a qualifying relative has to meet 4 specific tests that we're going to see. So the first is going to be, if you remember when we were setting out those 3 general tests, this was for a dependent to be either a qualifying child or a qualifying relative. The first of those tests for a qualifying relative is that you're not a qualifying child. So if you meet the qualifying child test, you're going to be considered a qualifying child. If you do not meet the qualifying child test, then you fall into this grouping of tests. And the first is going to be relationship or member of the household test. And what that's going to be is a child or descendant child, and that's a grandchild or great-grandchild, stepchild, eligible foster child, brother, sister, half-brother, half-sister, or a descendant of them. Again, that's brothers, child, grandchild, great-grandchild, sister's child, grandchild, great-grandchild, and so on. Stepbrother, stepsister, here, father or mother, brother or sister of the parents, son-in-law, daughter-in-law, father-in-law, mother-in-law, brother-in-law, or sister-in-law. The gross income test is also the dependent must not have gross income equal or greater than 4,200. And then the support test, again, is that the taxpayer must provide, or in this situation, the taxpayer must provide over 50% of the dependent's support. So let's take a look at the concept check. You must meet one of these 4 tests to be a qualifying relative, not a qualifying child test, relationship or member of the household test, gross income test, and support test. That is false. 2, a qualifying relative can earn up to $12,000 for the year 2019. And again, that is false. So 4,200 is going to be the gross income test amount. Learning objective 4, determine the standard deduction. The standard deduction for tax year 2019 for single filers is going to be $12,200. The previous year, 2018, it was $12,000, so it changes year to year, usually increasing a small amount. So here it went from $12,000 to $12,200. Married filing jointly is going to typically just be twice whatever that single amount is. So in 2018 tax year, it would be $24,000. Here it's going to be $24,400. Married filing separately is going to be typically the same as the single rate, or half of the married filing jointly, so it's $12,200. The head of household, it looks like $18,350 is the amount. And where did they get that? That's going to be 150% of the single. So it's kind of splitting the difference between single and married filing jointly. So it's going to be $18,350. In 2018, it was $18,000. And qualifying widower is going to be the same as married filing jointly. Here it's going to be $24,400. So the standard deduction increases again for people who are age 65 or older or blind. If a taxpayer can be claimed as a dependent by another taxpayer, the standard deduction is limited to the higher of $1,100 or the taxpayer's earned income plus $350. So taking a look at the additional standard deductions for taxpayers who are 65 or older or blind, that would be for single, $1,650, married filing jointly or married filing separately, $1,300, head of household, $1,650, and then qualifying widower is going to be $1,300. So our first concept check here, what is the amount of the standard deduction in each of the following cases? Taxpayer single, 42 years of age and blind. That's going to be $13,850, so that's going to be the $12,200 for single, and then blind is going to be an additional $1,650. So the taxpayer is head of household, 37 years of age and not blind, so that's just going to be the head of household standard rate, so that's $18,350, which is 150% of that $12,200. And then taxpayers are married filing jointly. Husband is 67, wife is 61, and neither is blind. So here we're going to have the $25,700 for the total. We're going to have $24,400 for the married filing jointly. One of the taxpayers is over 65, so an additional $1,300 for that to get to $25,700. Learning objective 5, the amount of the tax due to the Internal Revenue Service. So the amount of tax liability is computed using those tax tables, or the tax rate schedule. And the tax payments and credits are going to reduce that tax liability. This is typically paid by withholding from by the employer for the benefit of the employee. If there is not, for example, if it's going to be capital gains through maybe a purchase and sale of stock or something along those lines, the individual is going to be required to pay an estimated tax payment using a voucher to the IRS. And then that's going to reduce the amount due on April 15th. So you're going to have the total liability for the course of the year, and then the amount paid either by the employer withholding it and sending it in, or the tax filer themselves sending it in advance. Tax credits are also going to reduce that tax liability. There's 2 different types of tax credits, and it's important to know the difference. Non-refundable tax credits will reduce tax liability until there is no tax liability, until you get to 0. And then we'll stop after that. Refundable tax credits essentially can go negative. So if you have $1,000 of tax liability that you would ordinarily owe and have not had any withholdings, had not had any estimated payments, if you had a $1,500 non-refundable tax credit for that $1,000 tax liability, then you would have zero tax liability and zero payment or refund at the end of the year on April 15th. If you had a refundable tax credit of $1,500 in addition to the $1,000 tax liability, then you would be entitled to a $500 refund. Even though you hadn't paid anything in withholding, hadn't paid anything in estimated taxes, you're still going to be entitled to a $500 refund because of that tax credit. So again, the tax refund and amount due with the return, the excess payment results in a refund. So if you paid more over the course of the year, you'll get that back. And then the remaining tax liability means it's an amount still owed to the IRS. So let's take a look at the concept checks here. Using the tables in the using the tables in the back of the text to determine the tax amount of the following situation. Single taxpayer with taxable income of $34,640. And we can look there and see that it's $3,961. Married taxpayers filing jointly with a taxable income of $67,706. And we can take a look there and see that it's $7,739. And for the third one, what is the limit on the FICA Social Security amount for 2019? And that's going to be $132,900. Learning objective 6, interest and penalties the IRS can assess. Interest charged on assessments, the rate charged in the federal short-term rate, the rate charged is the federal short-term rate plus 3 percentage points. And then examples are listed here to give you a sense of what that is. In 2019, it was 6%, so that's going to be a 3% federal short-term rate plus 3 percentage points. Going back to 2015, 2016, be a near zero federal short-term rate plus 3 percentage points. So that kind of gives you a sense of how it fluctuates kind of term to term there. Penalties, failure to file a return is going to evoke a penalty of 5% per month or fraction of a month, not to exceed 25%. And then any income tax return not filed within 60 days of its due date is subject to a minimum penalty of the lesser of $215 or the amount of the tax required on the return. And then there's a failure to pay tax penalty as well. So it's important to know that there's a requirement to file a tax return and you'll get penalized if you don't file. And then there's also a requirement to pay and you'll be penalized if you don't pay. And that penalty is going to be 0.5% per month or fraction of a month, not to exceed 25%. So the max amount is 5% per month or fraction of the month, not to exceed 25%. So when both penalties apply to the same situation, it's still going to be that 5%, 25% for the maximum. So failure to pay estimated income tax applies if the taxpayer fails to pay during the year a minimum of either 90% of the current year's tax or 100% of the prior year's tax liability. And then that will come in if the taxpayer's AGI in the prior year is less than $150,000. And where that typically would come into play is if you have income that is not having withholdings from it, and you did provide estimated payments in the previous year, then you have a requirement to keep doing that in the current year to make sure that you meet that threshold. So you either have to make payments adding up to 100% of what the prior year's amount is, and using the prior amount as your estimate for what you should be paying this year. Or if you are estimating it a different way, you need to get within 10% of being correct. So you need to get 90% of what the current year's tax liability is. The other area where this might come into play to where you may not have a good estimate of it is if you had withholdings from the earnings in the previous year and are not this year. So if you don't do those estimated payments, then you may fall into this and have that failure to pay your estimated taxes. There's an accuracy related penalty as well, and that applies when there's negligence or any substantial understatement. The rate is 20% of the tax due. There's also a fraud penalty, and that's going to apply to the understatement of taxes that is attributable to fraud. So if you're intentionally trying to defraud the government, here that will be a rate of 75% is what that fraud penalty could be. And then there's an erroneous claim for refund or credit. The rate is 20% on the disallowed amount of the claim if the claim for refund or credit of income filed is found to be excessive. And that's not applicable if the fraud or accuracy-related penalty has been assessed. So let's take a look at the concept checks here. A taxpayer filed an automatic extension before April 15th but sent no money into the IRS, then filed a return by June 2nd and paid the amount due of $3,000. What are the amounts for the failure to file tax return penalty and failure to pay? And it's the failure to file does not apply, and the reason why is because the extension was timely. The taxpayer filed for the extension before April 15th, so there's no penalty for failure to file. However, you still are required to pay by April 15th, so that there will be a failure to pay penalty. So what the tax filer should have done was file for the extension, but make a best estimate of what that tax penalty, or excuse me, what that tax liability would be, and then provide the $3,000 on April 15th along with the extension. Concept check 2. Fraud on tax return can also lead to criminal charges, true or false? And that is true.